Good morning. I have a special guest today. I have Randy from Legacy Mortgage. So we're going to be brief about the daily update. Today's September 29th, right? Okay, and we have new homes. We have 6 new homes on the market, and 3 went off the market. They did not find an owner, unfortunately. We got to work on that. 14 new deals, 14 new price changes, so that's great, but 14 homes went off the market at the same time. 266 under agreement. They're really working on their new owners. Okay, so we're gonna get started quick. Again, this is Randy from Legacy Mortgage. I'm sorry, all day long I've been calling it Coldwell Banker Legacy Mortgage because they're very similar to our name. So, Randy, you ready?
Thanks for having me. Yes.
Okay. So, what should clients expect when we first send them to you? I mean, what we do is we send them. A lot of clients think it's going to be a nightmare. You're going to go off laughing. I mean, what do they expect? I mean, what should they expect? I apologize.
They should be comfortable. Typically, we have to get their name. We do have to ask them permission to pull their credit report. We need to get their personal information, pretty much get their residence history for the last 2 years. We do need to know their employment history for the last 2 years as well. We need to get their income information for their gross monthly income, any other supplemental income that they receive on a monthly basis. And most importantly, we do have to pull their credit report. A lot of times the buyers are skeptical having their credit pulled. However, it is part of the loan process in order to make a credit decision. So we do have to pull credit. And once we get all of those pieces to the puzzle together, and also I should add their assets. So how much money they currently have in the bank and checking, savings, retirement funds, 401k. Once we get all of that information and look at the whole picture, we're able to make a credit decision. And it only takes, honestly, about 10 to 15 minutes max.
Okay. So if they're not approved for a loan, you get a big old stamp out and you put decline and you give it back to them and you say bye.
No.
I mean, how does that work?
So once we look at all the pieces, and let's say, unfortunately, a customer, their credit score is a little bit too low to meet the investor guidelines, we'll advise them, what they need to do. It might take a few months to get the credit score raised, or they might need to pay off a couple of accounts in order to make it work. But we're not going to just disregard them. We'll give them advice and tips as to what they need to do and encourage them to try again.
Will you work with them for this time to get there?
Yeah, we will. I mean, we're not credit counselors, and we're not going to actually sit there and monitor their credit. However, we're going to tell them exactly what to do in terms of not making late payments, not having collections. If they do have student loans, let's say, where they haven't made payments on, or they're in forbearance, we'll advise them as to what to do to make sure that they're hopefully on the path to getting pre-qualified.
Oh, I see. Now, I have clients that tell me, well, I know my credit score is 700 or whatever the case may be, and what they do is they bring me this app. It's like Credit Karma or Credit Sesame, and they show it to me. I say, oh, great, we're good to go. I said, but you still got to talk to a lender. Can you explain further what you think about Credit Karma, Credit Sesame, and how does that affect what your side of it is compared?
Absolutely. I think those sites are wonderful. I'm a big fan of Credit Karma. I use it myself. However, it's not what the lender uses when we pull credit. So it gives us as the general public an indication of where our credit score, what our credit score is. However, it's usually only accessing 1 out of the 3 credit bureaus.
Oh, I see.
So if, TransUnion usually works with Credit Karma, and it might be 1 score, but Equifax, and then you have Experian, which is not a triple merge credit report, which is what the lender needs to pull when they're making a credit decision. So typically in order to have no issues at the very last minute, we will pull a tri-merge credit report accessing all 3 bureaus at that time to see what those 3 scores are. And then we always use the middle score, not the highest, not the lowest, but the middle score, in order that would be the score used to determine the credit score.
So speaking of scores and determining the credit score, how does the credit score affect the loan process? I mean, do you have to have 8+ credit, 800 and more? I mean, how does that affect the process of buying a home?
So typically an investor has a minimum guideline for credit scores. So I'd say anywhere from a 620 is pretty much, safety range and above. So once you fall below a 620, there are some companies that say that they can do loans at 580 or 600, and everybody, gets excited about that. But that means that they just need to make sure that the buyer has other factors, or there were reasons as to why the score is in the 580 level. But typically, I'd say a safe range is anything from 620 to above and above. And but it does not have to be an 800 credit score. It doesn't have to be a 700 credit score. There's, as long as it makes sense and there's reasons, then sometimes that can be explained.
Does that affect the interest will their credit score affect their interest rate?
It does. So
okay.
So I keep saying typically.
No, that's fine.
But with credit, with the whole mortgage process, so much of it is based on risk. And they changed the mortgage process to the interest rates are no longer, everybody has the same rates. This was maybe about 10 years ago or so. They've made changes so that everything is based on risk-based pricing. So those that do have a higher credit score might get a different interest rate than ones that have a credit score that are, 600 or below. So everything is based on risk, and that's what's used to determine the interest rate.
Okay. Now, another question. I have clients that have excellent credit. They pay their bills on time. They're making payments. They own 3 cars. They own, tons of credit cards. They have wonderful credit. They make the payments. But then I send them to you, and, we have a debt-to-income issue. And I have to explain to them, which is a good thing, okay, I have to explain to them why it won't work and how to get to where it will work. Can you explain more about debt-to-income ratio?
Absolutely. So with debt-to-income ratios, the investor who's lending the money basically puts a cap as to the maximum amount of debt that you have on a monthly basis. So your minimum credit card balances, your installment loans, what those monthly payments are, those monthly obligations. It's only revolving credit, installment loans, and student loans. So that's really, and any sort of other mortgages that it consists of. So utility bills and gym and cell phone, that doesn't count. But basically those minimum monthly payments, you add them all up and then you divide that by your income. If it's on a conventional loan, they say the max debt to income, the back ratio for the total debt in comparison to your income can be at 45%. So it's kind of a mathematical system. It's pretty easy to figure out when you add all your debt and then divide it by your income, what if it exceeds 45% on a conventional loan. It might be a little tough, but there is ways of working that out. You can try to pay that down, you can refinance loans or whatever, car payments, whatever the case may be, to try to lower that debt to income ratio.
So let's say I have high credit card debt, and I have but I have liquid cash, and if I just pay those off, we can go ahead and move forward.
Absolutely.
Does that work?
Yes.
Oh, okay, perfect. Okay, so we got through the loan process. I have a client that's approved, ready to go, and you have a client that's approved, ready to go with us. What's the next step? I mean, we found a home, by the way. We found a home. We give you an offer. You say, okay, we're under agreement. These are the terms of the agreement. I give you that offer. What is the lender doing now?
So now that we basically gave them a pre-qualification letter and they are ready to move forward, we will ask for the actual hard copies and paper when it comes to pay stubs, tax returns, W-2s, copies of driver's license, social security card. Those are pretty much the base, and bank statements. So those are we would need the actual physical copies of those items. We will then get permission from the agent and from the buyer to move forward and order an appraisal. So that is also part of the process. Make sure that the house is valued and worth what a third-party appraiser is stating it is. So that we need to make sure that our investment is solid and that they're not buying more than what the house is worth. So that's a part of the process. So once we get all of those, make sure that the title commitment, we ask for a title commitment from the title company, making sure there's no liens against the property. So then once we get all of these pieces, we submit it to underwriting. and an underwriter will then review the file and then hopefully give it an approval and go to closing.
Oh, excellent. So, okay, so we get it all going. I give you a contract. How long is it within a week I can get into the house? And what's the time process on this?
Well, that's a good question. It does take at least 30 days to facilitate a closing. So I'd say just to gather all the information, there's mortgage disclosures as well that the buyer needs to sign and date. But once we get everything that we need and submit it to our underwriter, there's also verifications behind the scenes, like verification of employment. If a customer is renting, we will need to verify the rental history. So when it takes, I'd say, a true 30 days to get to the title to close, to 45 days. However, the things that are in our control, such as getting the documentation and the paperwork, it can take probably a week, and we can make that decision right away.
Okay. Now you were talking about appraisers. Okay, appraisers. Do you have a guy? You just pick up the phone book and you call this appraiser. How does appraisal work?
So with an appraisal, we have to have an approved list of appraisers in the area. And what we do is we work off of a rotation basis. We can't, an agent or a customer can't request a specific appraiser. They just have to be on that list, and we just make it fair and square and just go through the list on a rotating basis. So with the VA, when we're ordering a VA appraisal, those are done directly through the VA website. And those appraisers, again, they're on a rotation basis as well.
Oh, nice. And then you also spoke about underwriting. What is underwriting?
So underwriting is basically every lender has an underwriting department, and that underwriter is responsible for reviewing the file in detail and the potential risk that the loan has. So let's say the underwriter they are knowledgeable about all the guidelines on a loan and what is permissible and what is not. But their biggest role and their job as a whole is just to really, as an unbiased party, review that file and make sure that they're complying with the investor's guideline, but weighing the risk of the loan. So what they can and can't do.
Okay, so I always tell my clients, don't buy a car, don't go buy the furniture yet, don't buy a washer dryer, don't buy appliances, wait till we close. And then they turn around and ask me why. I tell them the reason, but I want everybody to hear it from the lender. Okay. Why don't you use your credit during this process?
Because basically when we take the information and we're reviewing the credit history at that time of application, we're making that decision looking at that picture right then and there. So if a customer goes out and buys a car and adds a $500 monthly payment, that could completely kill the deal and cause the debt to income ratios, as we talked, to be too high, and it could absolutely cause problems in the end and cause the deal to fall through. So it's really important that things stay the way that they are, in a sense where you're not adding additional debt, monthly debt, and that you're just, being conservative during this time, because you don't want any surprises. You don't want to incur more debt than what you already have during this process.
Oh, I see. Now, if there's an emergency and I have to use my credit, such as, I don't know, my car broke down. Do we consult you? Do we give you a call? What do we do in that case?
We should be advising you as well. I don't think it would, if God forbid there was an emergency and you do need to do that, yes, I'm sure it can work out. However, you do want to call just to make sure to see what the amount is, how much, do you have legroom, do you have to charge versus, really incurring thousands of dollars that could affect the credit approval. So it is important to communicate with your lender, to definitely communicate as often, and they should be advising you what you can and can't do. So you don't have to put everything on hold and not live your life, but you do need to just be aware and cautious as to adding furniture payments and things that could definitely be a factor. They will have to be explained if any new debt is added or if your credit is pulled by another company. All of that will have to be explained as well.
Okay, so you're always accessible during the process. They can always call you.
Absolutely.
Okay, and then at the very end, we've done underwriting, we did appraisal, everything's fine. we're going to touch base on appraiser about what happens if the home doesn't appraise too. But we've done everything. We're almost here at closing. What do we do at closing? Do you write us a check? Do you put it in my bank account and then we just transfer it? How does closing work? How do you, I guess, fund the loan? Yeah.
So that's the best news anybody wants to hear, is that your loan is ready to go to closing. And once you're ready to go to closing, our closing department, or most closing departments, will send instructions to the title company. So this is done behind the scenes, and we're sending instructions to the title company as to what all the fees are and how to place them on the loan estimate, which will be in effect after October 3rd. So, or a HUD-1. So again, this is just time sensitive as to what we're going to call the actual closing statement. But those fees will be dictated. We'll work with the title company how to put them and list them. And then the funds are actually wired from the lender to the title company what that mortgage is to do the loan. However, then the buyer will be told if they have a down payment, if there are additional closing costs, what that amount would be, and then they would then arrive to closing with a cashier's check as to what is their portion, what their investment is into the transaction. So there's nothing to worry about as to, what the buyer or the agent needs to do at that point. It really is up to the lender to communicate that with the title company, get the numbers in place, and then the funds are handled, like I said, through a wire transfer from the lender to the title company for the house, and then just anything remaining, the buyer comes to closing with a cashier's check.
Okay. I just wanted to, okay, very good. What I want to go back to is the appraiser. If the appraisal comes in, we went under agreement for a $150,000 home, but the appraisal came in at only $140,000. Do you guys just up the loan, or what do you do?
So we can only lend money based on the amount that the appraisal comes in at. So whatever that value is. So that means that if the buyer still wants the house at $140,000, they would have to pay that extra $10,000 out of pocket in order to, keep the deal together based on whatever the selling agent and the buyer can work out, or they would have to renegotiate the sales price and reduce that sales price to the $130, and then the lender will go forward and
Oh, I see.
provide the
So
funds.
me as an agent, I would renegotiate for you,
Right.
on that price to bring it down to the appraisal value. Alrighty.
And that's for the buyers, for their protection and for the lender's protection, that we do that just to make sure that the house is worth what they say it is.
And if it doesn't appraise, sometimes they get a better deal than they thought they were going to get.
Right.
So, Randy, that's about it. So I have. Do you have anything to add to our clients out there and our future clients and
No,
past clients?
I think that the process, as long as you work with a lender who's going to explain the process in detail and really go over what the expectations are and how it works, and that it really is easy to accomplish. It can be done quickly and efficiently, just if you have a good cooperation and communication with your lender and the buyer. It's not, it can be overwhelming, but you just have to be prepared for that, since things have gotten a little harder within the last 6 years. So you do need to just be patient and know that it as long as it makes sense and we work together, I think it's definitely something that can be a easy, efficient process.
Perfect. And what is your phone number so people can call you?
So my phone number, please call me, don't hesitate, 915-204-3867.
Okay. And do you have an email they can email you questions as well?
Absolutely. It's R Cabrera, that's R-C-A-B as in boy, R-E-R-A, at lending, Lending, at legacy, legacy.com.
Perfect. And I'll put it on there as well. I'll put it in the background so you guys can see it. Just copy and paste it, or I'll make a link out of it, or you can just click and send her an email. Well, thank you, Randy. I appreciate your time.
Yeah,
I know you're a busy woman.
Thank you.
Okay. Well,
My pleasure. Thank you.